If you've got $2 million or more saved for retirement, a stock market crash doesn't just mean red numbers on a screen. It could mean watching $600,000 or $700,000 of your life's work disappear in a matter of months, depending upon how you are invested. And if you're already retired and pulling income from that portfolio, well, that damage can be permanent. Here's what keeps me up at night for our clients. It's not the crash itself. Markets crash. That's what they do. What terrifies me is when someone panics at the worst possible moment, sells everything, locks in massive losses, and then sits on the sideline while the market recovers without them. We manage over $900 million as of the end of 2025 for retirees and pre-retirees across more than 22 states. And I can tell you, the people who get hurt the most aren't the ones who experience the crash. They're the ones who didn't have a plan for it. So today, I'm going to walk you through exactly how crashes and corrections work, what they actually look like in dollar terms for a $2 million plus portfolio, and what you should consider doing right now before the next one hits. I'm Mark Fonville, a certified financial planner and CEO of Covenant Wealth Advisors. We're a fee-only fiduciary firm, which means we don't earn commissions and we sit on the same side of the table as our clients. Everything I'm going to share with you today is based on historical data and the strategies we actually use with real clients managing 7- and 8-figure portfolios. So before we get into the numbers, let's clear something up. The media loves throwing around scary words whenever the market dips, but there's a real difference between a crash and a correction, and understanding that difference can keep you from making a very expensive mistake. A stock market correction is generally defined as a decline of more than 10%, but less than 20% from a recent peak. Think of it as the market taking a breather. A stock market crash, on the other hand, or what we call a bear market, is a decline of 20% or more, and that's where things get serious. And anything less than 10%, well, that's just a dip or a pullback, and it happens all the time. So the next time you see a headline screaming about market crash, ask yourself one question: how deep is the decline? Your answer will tell you a lot more about how often something like this actually occurs. Now, let's talk about how often these things actually occur, because I think the data might be super helpful for you. Since 1950, the S&P 500 has declined by 20% or more on 13 different occasions. The average stock market crash sees a price decline of about 33%, and these bear markets last an average of 338 days, or roughly 11 months. Let me put that in real dollars for you. If you got a $2.5 million portfolio and the market drops 33%, which is the average crash, your portfolio falls to roughly $1.6 million. That's an $830,000 loss on paper. Now, the worst crash in recent memory, 2007 to 2008. The market dropped almost 52%. On a $2.5 million portfolio, that's a decline of $1.3 million. Your portfolio goes from $2.5 million down to $1.2 million. That's gut-wrenching, and it's exactly why having a plan matters so much. By the way, if you're finding this helpful and would like to be notified when we publish new videos about once a week on how to make your money last in retirement, be sure to like this video so I know what topics are resonating, and click the subscribe button. Now, here's what the scary headlines rarely tell you. The bull markets that follow crashes tend to be significantly stronger and last far longer than the crashes themselves. The average bear market, for example, cuts stock prices by about 35.8% from peak to trough. But the average recovery takes about 2 years and 2 months. In the March 2020 crash, the market recovered in just 6 months. And here's the big picture that really puts this into perspective. $1 invested in the S&P 500 Composite Index at the beginning of 1926 would have grown to approximately $21,451 by the end of December 2025, assuming you reinvested all dividends. And keep in mind that you cannot invest directly in an index, and this excludes fees and taxes. Now, think about everything that happened during that 100-year span. The Great Depression, World War II, stagflation, the dot-com bust, the financial crisis, a global pandemic. Through all of it, the long-term trend went in one direction over, again, the long haul. And as you may know, past performance is not indicative of future results. Now, let's talk about corrections, because these are actually far more common than crashes, and they can still rattle you quite a bit. Since 1980, the stock market has experienced a 10% or greater correction roughly every 1.2 years. So you could say corrections are basically a normal part of investing. The average correction sees the market drop about 14.3%. It typically takes 5 months to reach the bottom, but here's the encouraging part. The average recovery time for a correction is only about 4 months. Now, on a $2 million portfolio, a 14% correction means a decline of about $280,000. That's not fun, but if history is any guide, the recovery tends to come relatively quickly. Now, even smaller pullbacks of 5% or more happen about 4.6 times per year on average. So if you're checking your portfolio every day and getting anxious every time it drops, you're going to have a very stressful retirement. Now, here's where this gets really important for anyone who's retired or within 5 to 10 years of retirement. Sequence of returns risk is one of the largest threats to a $2 million plus retirement portfolio that most people have never heard of. And we even recorded a video on sequence of returns risk, so be sure to watch that video next. It's really the reason a market crash hits retirees completely differently than someone who's 35 years old, for example. And here's why. When you're accumulating wealth, saving money, adding to your 401k, a market crash actually helps you. You're buying shares at lower prices, and that's a good thing. But when you're in retirement and you're pulling money out of your portfolio to live on, a crash at the wrong time can permanently reduce how long your money lasts. You're selling shares at low prices to fund your lifestyle, and those shares never get the chance to recover. Now, let me give you an example. We got 2 retirees, both starting with $2 million, both withdrawing $80,000 per year, increasing at a rate of 2.5% per year. They earn the exact same average returns over 20 years at 6%, but one experiences big losses in retirement and the other experiences them late. The retiree who got hit early could run out of money years sooner. In this hypothetical example, the individual runs out of money in year 11, even with identical average performance. That's sequence risk, and it's why your investment strategy has to change as you approach and enter retirement. So what do you do? Well, 3 things. First, accept that crashes and corrections will happen. They're not a question of if. They're a question of when. Trying to predict them is a losing game. They're driven by different events every single time. Second, make sure your portfolio is built to withstand a downturn. That means having the right asset allocation. That's the right mix of stocks, bonds, cash, so that when the market drops 20% or 30%, you're not forced to sell stocks at the worst possible time. You want enough and stable assets to cover your income needs for several years without touching your stock positions. And then third, have a written plan that tells you exactly what to do when markets fall. Not a plan you make up in the moment, a plan you created when you were calm, rational, and thinking clearly. Because when the market's down 30% and every headline is screaming sell, that is the worst time to make financial decisions. Now look, the data is clear. Markets crash, markets recover, but the question for you is your portfolio actually built to handle it? If you've got $2 million or more and you're not sure whether your current strategy can survive a prolonged downturn, or worse, you don't have a strategy at all, it might be worth having a conversation. At Covenant Wealth Advisors, we offer a free strategy session where we'll chat about your specific situation, your portfolio, your income needs, your tax picture, and give you an honest assessment of where you stand and how we might be able to help. No sales pitch, just straightforward conversation. There's a link, by the way, in the description below so you can book that. Now, if you found this video had helped you think differently about market risk, do me a favor, hit that subscribe button so you don't miss the next one. We put out new content every week focused on helping retirees just like you and pre-retirees make smarter financial decisions. Thanks so much for watching. I'll see you on the next one.